Meet Adam, disciplined, punctual, and proud of his monthly ritual. Each payday, he transfers a slice of his paycheck into the bank, watches the numbers climb, and sleeps well convinced his future is safe. One morning, he walks into a grocery store, buys the same basket he used to buy for $80, and at the counter, the total rings up as $95. Confused, he checks his bank app. His balance has grown a little thanks to interest, but somehow that growth doesn't buy the same groceries anymore. That's the moment the story bites. Adam realizes the bank's interest is a lie when stacked against the quiet, relentless force of inflation. The bank gives you comfort and a tiny percentage. The economy quietly takes away purchasing power. Keeping cash in the bank becomes not safety but surrender. Your money sits, safe in appearance, while its future value dissolves. This is your wake-up image, the safe vault that actually leaks value over time. And it's the reason Adam goes hunting for smarter places to park his money. Adam begins to read. Inflation isn't a rumor, it's a measurable force that eats away at the real value of cash. Prices rise because economies expand, supply chains glitch, or central banks print more money. Whatever the reason, a currency unit today buys less tomorrow. The bank's headline interest rate might say plus 1% annually, but if inflation runs at 5%, the real return on that cash is minus 4%. That's not just theory. It's the daily reality that turns yesterday's comfortable savings into tomorrow's struggle. In the whiteboard, draw a cartoon dollar physically shrinking while a grocery cart grows more expensive. Show the bank smiling and handing an interest coin while the shadow behind it, inflation, carries away 5 of your coins. Adam's feeling shifts from security to betrayal. He wasn't losing money by some dramatic theft. He was losing purchasing power incrementally, invisibly, and permanently if he left his cash idle in the bank. Adam's first move is tangible. Buy a small apartment and rent it out. Real estate behaves differently from cash because it's an asset that often appreciates while also producing income. The whiteboard shows Adam signing papers, tenants bringing monthly rent checks, mortgage shrinking, and property value climbing in the background. Unlike a bank balance, a property can be improved, taxed advantageously, leveraged, and it produces actual cash flow that tends to keep pace with inflation. Landlords can raise rents, buildings can be renovated to command higher prices. Real estate also offers psychological advantages. It's physical, you can see it, and it forces you into a longer-term mindset where value compounds over years and decades rather than disappearing overnight. For many savers stuck with cash, owning even a small rental is the first practical act of rebellion against inflation. It turns sitting money into a growth engine and a hedge that reduces the chance your savings will erode unseen. After real estate, Adam learns about index funds, the simple low-cost vehicles that let you own a slice of many companies at once. The whiteboard animates a basket labeled S&P 500, filling gradually as Adam makes monthly contributions. Unlike picking single stocks, index funds spread risk across sectors and companies and capture the market's long-term growth. Historically, broad market indexes have returned significantly more than bank interest and have beaten inflation over long periods thanks to corporate earnings growth and compounding reinvested dividends. For Adam, dollar-cost averaging into an index fund turns disciplined saving into a predictable wealth-building routine. Some months shares are cheap, some months expensive, but over decades that routine smooths out volatility and benefits from compounding returns. This scene frames index funds as the modern saver's superpower, easy to implement, low friction, and historically reliable at transforming cash into wealth rather than letting it wither in a bank account. Not everything Adam buys needs to roar with returns. Some assets exist to preserve value. Gold is the classic example, a metal that has stored wealth across generations because it doesn't rust, vanish, or depend on any single government's printing press. The whiteboard shows gold coins quietly sitting in a safe while currencies around them fray and stretch. In times of currency crisis, geopolitical shock, or runaway inflation, gold historically maintains purchasing power when paper money loses it. Adam doesn't treat gold like a growth play. He treats it like insurance, a ballast in his portfolio that offers protection when correlated markets fall. This scene emphasizes a portfolio balance. Growth assets, like stocks and property, plus protective assets like gold, reduce the emotional and financial shock when inflation or systemic risk spikes. Adam also explores digital assets, Bitcoin and select cryptocurrencies that advertise scarcity, decentralization, and independence from central bank policy. The whiteboard draws a digital ledger, a shrinking supply chart, and a rocket labeled adoption crypto is volatile and controversial. But for some investors, it functions as digital gold, a scarce, borderless store of value that cannot be inflated away by a single government. Adam approaches cautiously. He sizes positions conservatively, learns the tech, and treats crypto as a diversification play that could outpace inflation if adoption grows. The scene candidly shows both the upside and the plunge. Crypto can spike and crash wildly, but placed as a small, intentional bet within a diversified portfolio, it can serve as an inflation hedge and an asymmetric growth opportunity for those who understand the risks. Beyond passive investments, Adam starts building businesses. The whiteboard illustrates a small online shop, digital products, and a side hustle that morphs into steady revenue. Owning a business is arguably the most powerful antidote to inflation because it creates pricing power and scalable cash flow. When costs rise, a company can often adjust prices, optimize margins, and grow revenue faster than stagnant bank interest permits. For Adam, entrepreneurship isn't romanticized, it's practical. He automates processes, reinvests earnings, hires smartly, and scales in predictable steps. Business ownership converts time and creativity into assets that compound. It teaches Adam to think in systems and cash flows rather than static balances. This scene highlights how income-generating enterprises turn exposure to inflation into opportunity. Businesses can survive, adapt, and often thrive when money alone would suffer. Perhaps the most underrated asset Adam acquires is knowledge. The whiteboard now shows books, short courses, and mentorship, a timeline where knowledge compounds like capital. Financial education sharpens decision-making. It reduces costly mistakes, improves tax efficiency, reveals leverage opportunities, and helps evaluate real risk versus hype. Adam learns about diversification, rebalancing, tax-advantaged accounts, and simple behavioral traps like panic selling during drawdowns. Unlike market assets that fluctuate, knowledge yields asymmetric returns. A small hour spent learning can protect thousands of dollars and create new income opportunities. This scene encourages viewers to treat their time as an investment, read, subscribe, study, and gradually convert that knowledge into better allocation choices and a higher probability of long-term success against inflation and bank complacency. Armed with alternatives, Adam constructs a simple playbook. Keep a short emergency stash in the bank for liquidity, but move core savings into a mix of index funds, real estate, protective assets like gold, a small crypto allocation, and ownership of scalable businesses. The whiteboard animates a pie chart, shifting from 90% cash/10% everything else to a diversified allocation that balances growth and safety. He habitually contributes dollar-cost averages into markets and treats investments like machines, automate where possible, reinvest earnings, and rebalance annually. This scene demystifies the process. Transformation isn't a single perfect move. It's consistent, boring, disciplined execution. For viewers, the key takeaway is simple. Cash is a short-term tool. For long-term security and growth, you need assets that produce returns above inflation and that give you options and resilience over time. Adam now calmer and more purposeful. His portfolio isn't a flashy headline, but it grows quietly and meaningfully. Here is your challenge. Pick one asset class from the video and commit to a small, recurring investment for 6 months. Read one high-quality book on investing, or set a meeting with a trusted advisor to discuss a real estate starter purchase. Let me tell you one more important information. Keeping cash in the bank feels safe, but slowly erodes your future. Wealth isn't a lottery win. It's a system you build, one disciplined choice at a time. Stop passivity, start an intentional plan today, and return to Wealth Core channel for tactical videos that show exactly how to begin each asset class step by step